What's up, everyone? Welcome to another episode of Finance Simplified, the official podcast for StreetFins. We're here to break down the world of finance for you to understand from a relatable perspective with discussions with experts. My name is Rohan, and this is episode 30. My co-host Alex is currently on vacation in Iceland, so he's unfortunately not able to join us today for the intro and outro, but you'll hear him in the rest of the episode. As a result, I'll keep this episode's intro short. This episode is part 2 of our conversation on the topic of simplifying options with Tom Sosnoff, the co-founder of tastytrade and Thinkorswim. We'll be diving into volatility, options pricing, trading strategies, and more in this part. But before we continue, we just want to remind you that if you are learning from our episodes and want to keep supporting what we're doing, we'd be eternally grateful if you gave us a 5-star rating and review on Apple Podcasts. Even if you're listening to this on another platform, as long as you have an Apple account or device, you can support us with the rating. Additionally, we'd love to know what feedback you have for us, so join us on Discord to send us any feedback to let us know how we're doing and what you would like to see from us going forward. Also, stay tuned till the very end of our episode because we'll be teasing out our next episode's guest. The first person to send us a message on Discord with the correct guest will get a shout out. Now, let's continue simplifying options. Welcome to Finance Simplified, the official podcast for StreetFins created by students that simplifies the seemingly complex
and confusing
world of money. We're your hosts, Rohan
and Alex.
Yeah, so you were talking about bid and ask spreads earlier and talking about how the options market, the bid and ask spreads are kind of tight there, as in, they're a few pennies apart, and bid and ask spreads typically indicate, if it's a liquid asset or not. And so another kind of feature that I think also might indicate liquidity is how many times there's an expiration date or how frequently expiration dates appear for a certain stock's option. For example, if there's options that expire every single week, then it might be a more liquid stock rather than one that has maybe once every 3 months or something like that. So is there any other feature other than the bid and ask spread that might indicate liquidity for options, maybe like expiration or something else entirely?
It's usually not a function of the expiration cycles. Obviously, you'd like to have as many strikes and as many cycles as possible, but sometimes the market making firms are limited by bandwidth. I would say that the most important thing to look at is the bid-ask spread, the underlying stock volume, and also the option volume. If there's no option volume, stay away. And if there's no option volume, you can check open interest, but if there's no open interest is essentially just the number of contracts that have been created in the underlying. If there's no open interest or no volume, just stay away. If there's volume and there's stock volume, you don't even have to care, but open interest doesn't mean anything. You're plenty good to go. So I would say that, first of all, the most important thing about trading is liquidity. And then the second most important thing is learning how to judge that liquidity. And that comes with really looking at the stock volume, the option volume, and then the width of the bid-ask differential. Like you can have a $50 stock with let's say a 3 or 4 cent bid-ask differential, or you can have Amazon, which is a $3,500 stock with a $1 bid-ask differential. And Amazon might have tighter markets. Like right now, if you said to me, where are the tightest markets? I'd probably have to say something like Tesla, which is $650 stock, let's say, with on average, maybe 5 or 10 cent wide markets, which is pretty good for a $650 stock.
Yeah. And you mentioned Tesla just now. And one thing that kind of strikes me about the options market is just how much more, I think, volatile it can be than the regular stock market, which again, it gives rise to kind of these risk management strategies that Alex will go over in our next section. But, how volatile is the options market compared to other markets? Like, every time I see a stock increase in 1%, the option is much higher. And that volatility, is that just like a feature of it, or is there something that you can do to like kind of deal with that volatility?
Well, remember, like I mentioned earlier, volatility is a really important measure for us. It's the single most important thing after liquidity that we look at. And the reason for it is I'm primarily an option seller, not a buyer. And so when I look at options, I'm always thinking, like my approach to trading is I don't want to try to beat a stock. I want the stock to try to beat me. And so I prefer to sell stuff rather than buy it, which means selling volatility. So I'm a premium seller. So I need to be able to measure context around volatility, which means I watch something which we call IVR, which is implied volatility rank. So we measure implied volatility against itself. We publish this on our platform in real time. And then we're able to say whether a stock on a relative basis has high or low volatility relative to itself, which gives us an indication of opportunity and interest. So that's how we play the game, which is either a little bit different than some premium sellers or a lot different than most premium buyers. You guys have to realize the reason that you're having this conversation with me and the reason you're attracted to options is because you're smart kids who are going to school. I don't know what your majors are, math or whatever. And the reason options are interesting is because you've recognized already that one, they're capital efficient, and two, they're supported by a lot of really interesting math equations and strategic decisions that you can make. Being on both sides of the market, you can play up, down, or sideways. It really doesn't make a difference. You can't do that in a static environment, and you can't do that with limited capital. So to me, the most interesting thing about options is that you can also decide if you want to have the high probability trade with the defined payout or the low probability trade with the undefined payout. And you can't do that anywhere else in finance.
Yeah, no, that's a fantastic point. And I think that is why options are so attractive. And I think that's why they've even become so popular across the retail community, because you can generate these outsized returns with small amounts of capital. As you said, very capital efficient. So that point's
or the other way around.
True. Yes, very true.
The other way around is you can generate an extremely high probabilistic outcome with lots of low returns. We take the approach, which is we believe strongly in law of large numbers. And I think the key to trading is creating successes. And you can't create successes in a random environment unless you put the numbers in your favor. So that's my approach, which is very different than most others.
Maybe we can kind of get your opinions on some really basic option strategies. And, as I mentioned before, it's going to be a lot of retail investors that are listening to our podcast, young students, maybe young working professionals. So maybe we can start with sort of the covered option. So maybe covered call, you take your portfolio and you go long on a few positions. When do you recommend, selling covered calls against those positions? How is it dependent on what the macro environment's like, what the specific premiums are? Are there any risks to that? I mean, are you worried about a lot of turnover in the portfolio if you're selling them really close to the current strike price, or really close to the current price? What are your thoughts on that?
So covered calls are a bullish position. In a perfect world, a covered call is put on when the stock price or the basis is low and implied volatility is high. So a covered call is a strategy you want to use because remember, it's a long delta position, which means it's a directionally long position. So you want to use covered calls when stock price is low and volatility is high, period. That is the best time. Most people do the exact opposite, and most people tend to use covered calls when the stock prices are high and volatility is low. It's still what we call high probability trade, but it's a lot less interesting to me. I like it when you're buying into a declining market, when you're buying stock in a declining market and selling calls with an extremely high implied volatility. I like selling the nearest out of the money strike as a default, and I like selling closest to 45 days. So buy stocks when they're dropping, sell the nearest out of the money call, buy the stock and sell the call when the implied volatility is high, and sell the nearest out of the money strike approximately 45 days to go to expiration. Macro factors have no application for me. Technical factors have no application for me. Cyclical factors, no application whatsoever. So I couldn't care less about an analyst report. I couldn't care less about a technician's report. I couldn't care less about a newsletter or anything like that. Nobody knows what's going to happen. Markets are random. And, I like to buy things when they're cheap and sell things when they're expensive.
Okay. Moving on to cash secured puts. What's sort of the best strategy for debt?
I commonly use short puts, not necessarily cash secured. There's no reason to use cash secured puts unless you're trading in an IRA account. And people your age should not be trading in IRA accounts because you don't need to have an IRA account at 19 years old. You should be trading in an individual margin account and getting the most leverage for your money. Now, that said, the nice thing about short puts are they have an extremely high probability of profit. Most out of the money puts have, a probability of profit anywhere between, 67 and 80%. So markets have positive drift. So you combine positive drift with high probability of success, and short puts are, an interesting way to trade. You only have to put up about 20% of the price of the underlying. And I think that, having to do cash secured puts is a little bit misleading because you don't need to, but doing a strategy of short puts totally makes sense. And I see no reason why every person listening to this podcast wouldn't start out one way or another, with the strategy of short puts or short calls.
Okay, interesting. And then moving on to sort of naked option, it seems like you are comfortable with traders playing naked options, but what are maybe some of the risks that should be considered with those?
Size. The risk of anything, the way the world works is in the world of trading and everything else. The only way that you get yourself in trouble is size. So when genius fails, it's always because somebody traded too big. Genius doesn't fail when you stay small and do whatever it is that you want to do strategically. Genius fails when your size gets too big. So I would say that the most important thing you can do as self-directed investors is I feel no need, that depends on the amount of capital you have. But if you have enough capital, I would much prefer to have undefined risk and naked options than I would defined risk. But the whole key to long-term success and not getting yourself in trouble is keeping your size small, because most people believe that the key to long-term success is risk management. And I call bullshit on that, because I don't think risk management is fair or even possible in most cases. I think the only way you can totally control a situation is on order entry. So if you keep your size small, I think that's the most effective way to manage your risk.
Okay, interesting. Because I was just about to follow up and ask you about maybe some more complex strategies, iron condor, butterfly spread. What are your thoughts on those? And you mentioned specifically that it's hard to do risk management. Would you recommend pursuing these strategies?
I think you should pursue every strategy that you find interesting and see what you like the best. For a few $100s, you can dip your toe in the water. And, you guys know the cost of education. You're in the middle of it, right now. And whether you're paying for yourself or whether you're borrowing the money or whether, your parents are helping, whatever it is, you recognize that education is crazy expensive. And if you have the opportunity for a very small amount of money to essentially teach yourselves the complex derivatives approach, whatever you're going to learn from academia, you're going to increase it tenfold by having your own experiences in the space. This is something you couldn't do, 10 or 20 years ago. This is something you have the luxury of being able to do now. And everybody that doesn't take advantage of that, in my opinion, that hasn't engaged in finance, is grossly underestimating the value of trading, which is not just about making money. I don't think that at 18, 19, 20, or 21, you're going to change the direction of wealth creation for you over the next 20 or 30 years. But I think at age 19, if you learn how to trade, you are going to have a different appreciation for risk. You're going to have a different appreciation for strategy, and you're going to learn how to make decisions so much faster that it's going to be invaluable. And it's a huge differentiator as you move forward into the next steps of your career or schooling, whatever else it is.
Yeah, I think that's a perfect segue into our next section, which is kind of just asset allocation with options, thinking about how you should position your portfolio with options. So I guess my first question within this is, what percentage of a portfolio, even when we're young, will have other kinds of assets in our portfolios, but, what percentage do you think would be a good amount to allocate to options? Obviously, it's something that can be as small as, since you can play around with small amounts of money with options, it can be a small percentage of a portfolio. And, as you were talking about with size, it could go up to a much larger amount. But is there kind of a sweet spot you think that works for most people, even if it's like a range of percentages?
Sure. So I think you should be objective, and I think you should be very open-minded about different products. And the smartest thing you can do or say is to say, hey, I'm product indifferent, and not let yourself get, too caught up in worrying about, I want to be in this percentage of stocks, this percentage of options. I think in today's world, if you said to me, you have 1 or 2% stocks, I'd be like, totally fine. I think most young people today are too heavy into digital assets and not necessarily stocks. If you're a Gen Zer and you're too heavy into stocks, I think you're missing the real opportunities. I think, I think a couple of percent in stocks maybe, and I'm talking about a minuscule percent, especially, if you have limited capital. I think it's totally fine because of the higher volatility in digital assets, but to have some digital assets, some form of crypto, which is definitely not correlated to equities. So I think that that's a completely acceptable way to spend some of your capital. And plus you can get smaller size in there. So I would have a small percentage in crypto/digital assets. I'd have a small percentage in stocks, very small in stocks. I'd have zero bonds at these levels at all, zero. And most of my portfolio would be in options, futures options, and or futures because they're the most leveraged. And they're all three of those are the most strategic. So if you're asking me how I am, even at my age, I'm over 80% in options and over 90% in options and derivatives.
Yeah, that may sound kind of a bit unconventional given that, we've always heard about like an allocation of, have 60% stocks, 40% bonds. And, there's like a whole paradigm shift that's happening. I guess my next question that's part of this is, a lot of options trading seems to be a very active hands-on thing. You have to keep track of time expiration, things like that. Is there such thing as a passive options investment strategy?
Passive, no. Like log on today and then log on again in August, I'd say no. Passive in the sense that you don't have to log on 50 times a day. Yes. Like maybe once a day, you're just going to log on, see how your stuff's doing, make an adjustment if you have to, maybe open another trade, close something, do something like that. The answer is absolutely. But passive in that, like you bought an index fund and you wake up, a month or two later, no. The answer is no.
Okay. Sort of the next set of questions is really about, what's been happening with options over the past year, and then also some of your thoughts on the future. So I kind of want to start with, I guess, the phenomenon on Reddit with a lot of the Reddit traders and Wall Street bet traders trading options that are really out of the money and have short expirations. What are your thoughts on this phenomenon? And does it worry you a little bit that options are being used in really speculative ways like this? I remember checking the GameStop options chain and they were writing calls for $900 strike price. Does that concern you at all?
Every time somebody does stuff that they don't understand, it concerns me a little, but the upside of it is so much bigger than the downside. It concerns me when a group of kids, like, my son or his friends, they'll go to Vegas and they'll lose all their money betting on just playing craps and playing blackjack, right? They'll blow all their money. That concerns me, but I don't lose any sleep over it. It's just like, okay, great. Now you learned your lesson. But the takeaways from that are nothing. At least the takeaways from participating in the marketplace, I think, are actually long-term beneficial. And the number of people that will experience long-term positive benefits from being engaged in finance, I'm willing to take the risk from the few people that, blow out buying 800 calls in GameStop or selling 800 calls in GameStop, whatever they're doing. But for the most part, I'm willing to take that risk because I think in the long run, the benefits outweigh all those risks. Okay.
And, you've been really big on, I guess, democratizing retail access to options, through Thinkorswim or tastytrade. Do you see that trend continuing of retail investors sort of dipping their toes into option strategies? And where do you think option strategies go from here?
Well, we're on a mission. We've been on this mission for 20 years now. I think that we're still in our infancy. It's been exploited by the Robinhoods of the world, which is great, but I don't think they have the tools or the know-how to take it to the next level. And I think that's one of the really cool things about like what we do is all the content that really backs it up. But the simple answer is, if you're asking me if we're anywhere close to like saturation and stuff like that, the answer is I don't think so, not at all. I think you're going to see a massive explosion in lots more strategic trading. It'll come in the form of, there'll be tons of strategies on digital assets. There'll be strategies on event-based trading. There'll be strategies on politics, sports, everything else. It won't be one dimensional. It'll be very dynamic in the future. And I think people that have experience trading options will be able to participate at a different level and all that stuff. So my answer is we're nowhere close to, any kind of a saturated marketplace.
Yeah. And with that, this is our final question of the episode. And it's a question that I ask all my guests who have children, which is, knowing what you know about options finance, entrepreneurship, even with what you did with Thinkorswim and now what you're doing with tastytrade, just all that you know about, that whole world. What lessons have you given to your children about the world of money? And would you recommend the same for students today?
I mean, you know what it's like. I don't know what your relationship is with your parents, but it's hard to listen to your own parents. Like, you're probably listening to me more than you listen to your own parents, because that's just the nature of, kids. And I never listened to my parents. So, I wanted to, but, my daughter works for us and she's the chief compliance officer at Tastyworks, but it took her a few years before she, now she's been here almost, actually 9 years. So, took her a while to get in the business, but then she loves it and she's amazing at what she does. And my son and I are, have a couple of projects we're working on. So, but it took a long time for us to really kind of trust each other enough to, want to do things together. There is zero question that I think, I wouldn't hesitate to do it again, and I would do it earlier if I could. So to answer your question, I would tell my kids without hesitation, and I have told them this, that there are a lot of really important things you can do in life. And, obviously the most important thing is, to have some fun and enjoy while you're doing it. But you close your eyes one day, and I've said this many times, you close your eyes one day when you're about, 24, 25 years old, and you open them the next day and you're 50, and you wonder, hey, where the hell did my financial life go? And how come I don't know anything? So the idea that you guys are starting to learn this stuff at 19, it's amazing. And I think you should pat yourselves on the back and, and be really excited about what lies ahead for you, in this space in the future. So I think it's a good thing.
Yeah, well, with that, we want to thank you so much for being on the podcast. It was definitely great to have someone like yourself teach us about options today. And we look forward to having you back on for another potential future episode. Thanks so much.
That'd be awesome, guys. Thank you for having me.
Hey, everyone. That was the end of part 2 of our 2-part interview with Tom Sosnoff on simplifying options. We hope you enjoyed and learned more about options from him. The entire conversation was amazing. Here are some of the key takeaways from this second part. One key takeaway is that probably the most important things to look at when investing in options are volatility and volume. After all, volatility is the best measure of if an option will reach its strike price before its expiration date, and volume implies liquidity, meaning you can trade your option at a price very close to what it last traded for. Another key takeaway is that investing in options is primarily an active strategy, as opposed to a passive strategy. There isn't an index fund equivalent in the options world, so if you do choose to trade options, know that you'll likely spend more time learning about it, but that it's still worth spending time learning the different trading strategies. The final key takeaway is something that Tom said that I really want to emphasize. Almost all failures in investing occur because someone bets too big. It's an issue of the size of their bet. When investing in options or any other asset, when you truly fail, it's almost always an issue of betting too big. These takeaways wrap up our part 2 conversation. And now it's time to tease the next episode's guest. Remember, the first person who sends a message on Discord with the correct guess will get a shout out in the next episode. So here are the 2 hints for our next guest. Number 1, he's the second in command of the world's largest sovereign wealth fund. And 2, he's an expert on international finance. Since this episode is our 30th, this will be the last episode on a topic this year. We'll be posting the best insights from the past 30 episodes over the next few months, and we'll be back in 2022 with new interviews. In the meantime, we'd love to get to know our listeners, so feel free to reach out to us over email or social media. We'll talk to you all soon. Hey guys, I want to thank you so much for listening to this episode of the podcast. It truly means the world to us. If you like this episode and others, let us know by subscribing and giving us 5 stars on Apple Podcasts and following us on Spotify. Share us with your friends and check us out on Instagram and Twitter, both @StreetFins. You can also follow me on Twitter @RohanInvest. If you'd like to get in touch with us, please email fspodcast@streetfins.com. Thanks once again to Tom Sosnoff for his insights today. I hope you understand the topic of options in a more simplified way. I also want to thank Jeffrey Lee for his amazing audio editing skills and for having edited our audio for the past year. Once again, we're really happy that you're taking the initiative to learn finance and to better your future. If you haven't already, we highly encourage you to check out streetfins.com for articles, videos, and other content. Join the StreetFins community and tell your friends about us so that they can learn about finance too. We'll talk to you next time on Finance Simplified.